All right, let's get into it. Today, we're basically going to be financial detectives. We're going to take a look at a real-world stock analysis to piece together exactly how a company's stock can just completely fall off a cliff. It's a bit of a detective story.
So our story kicks off back in early July. There's this company, Next Technology Holding, or NXTT, and its stock is trading at a really healthy $500 a share. You know, for a lot of people, this probably looked like a pretty solid bet.
But then you fast forward just 3 months, and the whole picture has changed. I mean, completely. That $500 stock, it has absolutely cratered, hitting a low of around $20. That's not just a dip, that's a near total wipeout for anyone holding it.
So yeah, that's the big question, right? How on earth does a stock lose 95% of its value? That's the mystery we're going to dig into today. We're going to use a professional analyst's report as our roadmap to see what the data is really telling us.
Okay, first things first. Any good investigation has to start at the scene of the crash. So let's get a really clear picture of the damage and just understand the basic facts of what went down with NXT.
The damage is, well, it's severe. After that nosedive, the stock is now just kind of hovering in this very uneasy calm, stuck in a super tight trading range. But don't let that quiet fool you. The key thing to understand here is that the dominant trend is still what they call intensely bearish. All that means is the market's mood, the momentum, it's all still pushing the stock down. And that's not just a feeling, it's confirmed by the numbers.
All right, we've surveyed the scene. Now it's time to start looking for clues. And our first big piece of evidence is the trading volume. This tells us a ton about what investors were thinking and, more importantly, feeling as this whole thing unfolded.
This is where you can really see the psychology of the market in action. Back in July and August, when the stock was in freefall, the trading volume just exploded. A peak of over 3.7 million shares traded in a single day. That's not investing. That's the signature of pure, unadulterated panic. But lately, that feeling has shifted. The volume is down, but it's still pretty high. It suggests the panic is over, but now it's been replaced by this really tense uncertainty. It's like a standoff, with everyone just waiting to see who blinks first.
So how do analysts even begin to make sense of all this chaos? Well, they have a specific set of tools they use to diagnose a stock's health. Let's go ahead and open up that toolkit and see what these instruments can tell us about our case.
The first tool we're pulling out is the moving average. The best way to think of this is like a rearview mirror for the stock price. It smooths out all the crazy day-to-day bumps and shows you the general direction, the trend. The stock has been headed over a certain amount of time, like the last 5 days or even the last 200 days.
And wow, does this tell a story? Just look at that. The average price over the last 5 days is about $23, but the average price over the last 200 days, over $273. That massive gap shows just how violently the stock has broken from its own history. It's a crystal clear mathematical picture of a total collapse.
Okay, the next tool in the kit measures momentum. And a great analogy for this is a rubber band, right? If you stretch a rubber band way too far in one direction, it gets super tight and wants to snap back. These indicators tell us if the stock price has been stretched too far down into what analysts call oversold territory.
And check this out. It's not just one indicator. It's a whole bunch of them basically screaming the same thing. The RSI, the stochastic oscillator, the Williams percent R. Look, you don't need to be an expert on these. Just know they are all different ways of measuring selling pressure, and they are all deep in oversold territory. So that rubber band we were talking about, it is stretched incredibly tight right now.
Okay, so we've looked at the trend and we've seen the momentum. The next step in our investigation is to map out the current battlefield. We need to identify these key price levels that are acting as support. Think of them as floors stopping the stock from falling, and resistance, the ceilings that are holding it down.
Think of this table as our battlefield map. The support levels over on the left, those are the trenches where buyers are trying to dig in and stop the bleeding. And the resistance levels on the right, those are the barricades that sellers are defending. Right now, the stock is basically trapped in this no man's land between them. If it breaks below one of those floors or above one of those ceilings, that's a huge deal.
So let's recap. We've gathered all our evidence, we've seen the aftermath, we've analyzed the volume clues, we've taken our diagnostic readings, and we've mapped the battlefield. Now our analysts can finally put it all together and lay out some possible scenarios for what could happen next.
The evidence really points to 3 main possibilities. First, you've got the bullish bounce.
If the price can punch through that resistance ceiling, that stretched rubber band we talked about could finally snap back and cause a pretty sharp, quick rally. Second is the bearish breakdown. This happens if that support floor collapses. The stock could fall fast, maybe even retesting its absolute lowest prices. And third, there's the sideways stalemate, where the truce just holds and the stock keeps drifting, going nowhere fast.
But after weighing all the evidence, this is the analyst's final professional conclusion. And this quote really says it all. Even though there's a chance for a bounce, the overwhelming weight of that long-term downtrend, remember that's $273 long-term average, it's like gravity. And until the stock proves it can fight that gravity, the path of least resistance is still down.
And that really leaves us with this final question. Those oversold indicators, that stretched rubber band, that's a glimmer of hope, right? A chance for a rebound. But that devastating long-term trend is a massive flashing warning sign. And that's the real challenge for anyone looking at a situation like this. How do you tell the difference between a glimmer of hope and just another warning sign?